Remember that deli in New Jersey which was trading on the stock market for over $100 million last year with only $20,000 of revenue? Well, there's been another twist in this insane story, with the owners now finding themselves accused of securities fraud by the SEC. And don't worry, if this is the first time you're hearing about this multi-million-dollar meat shop, I'm going to be bringing everyone up to speed in today's video. In fact, I'm actually kind of jealous if you haven't heard this story already, because this is probably the stupidest example of fraud in Wall Street history. Let me first take you back all the way to the beginning of this story, and that is with David Einhorn. Investor David Einhorn first brought public attention to this company in 2021 in his quarterly letter to the shareholders of Greenlight Capital. And similar to many other successful investors, Einhorn uses his quarterly letters not just to talk about the stocks that he's invested in for his investors, but also to talk more broadly about either his investment strategy or about the economy. And that led us to a discussion about speculation and certain companies, including the one we're going to talk about today. And that company was Hometown International. Hometown International. Have you heard of it?
Aerodyne.
Huge military and civilian application.
In his letter, he said, someone pointed us to Hometown International with the ticker symbol HWIN, which owns a single deli in rural New Jersey. The deli had $21,000 in sales in 2019 and only $14,000 in sales in 2020 as it was closed due to COVID from March to September. HWIN reached a market cap of $113 million on February 8th. The largest shareholder is also the CEO, the CFO, the treasurer, and a director who also happens to be the wrestling coach of the school next door to the deli. The pastrami must be amazing. Small investors who get sucked into these situations are likely to be harmed eventually, yet the regulators, who are supposed to be protecting investors, appear to neither be present nor curious. From a traditional perspective, the market is fractured and possibly in the process of breaking completely. Of course, after this letter came out, this story was picked up by a number of big news organizations, including CNBC and New York Times, which a couple of articles we'll talk about in today's video. And then eventually, we actually discussed it on the Young Investors podcast. And on top of all of those responsibilities, so he's managing a huge company, 35,000 in revenue over 2 years. He's listed on the US stock market. On top of all of that, in his part-time, he's also the wrestling coach of the school next door to the deli. At the time, the stock had been listed on the stock market for about 2 years, and during that short time, it had surged a whopping 1,200%. So was all of this just an accident? Was this just a company getting swept up in retail investor speculation? Or was this an intentional attempt at inflating the little deli stock price? And if so, why would they want to do that? At the time, myself and many other people who looked at this company from a surface level just assumed that they were operating some kind of pump and dump scheme where the owners were trying to artificially inflate the stock price, get other investors involved, and then quietly dump their own holdings onto those investors. But upon a deeper look, Hometown International had about 60 shareholders, and this didn't really change all that much during this period, which meant they weren't pumping and dumping the stock onto a huge number of new retail investors, as you would typically see in a typical pump and dump. We now know that this fraud was not a pump and dump, but something that runs a lot deeper and actually reflects a loophole that is exploited by a lot of companies. But first, let's just understand how it's even possible for a single deli to even list publicly on the stock market. It doesn't seem like that would be something that's available to a business that is that small, doing $20,000 in revenue per year. It actually is very, very difficult to list publicly either on the New York Stock Exchange or the NASDAQ, as there are very, very strict criteria that's involved in listing on those markets, especially through an initial public offering. However, there's actually a third option available to business owners, and that's to list on the over-the-counter markets. The over-the-counter markets enable investors to trade shares directly to one another without using a centralized marketplace like the New York Stock Exchange or the NASDAQ. Essentially, the OTC markets give investors access to a wider variety of companies. However, there are quite a few downsides to trading shares on the over-the-counter markets. The biggest downside is the lack of liquidity. These shares often are traded very, very thin, maybe not being traded for many days or many weeks at a time. And that means that it can take a very, very long time for your trade to go through, whether you're selling or buying, and there can be massive variance in what the value or the price of those shares are on a given day. But there's one other downside, which is a downside for investors, but actually reflected an upside for Hometown International, is that the OTC markets have a lot less regulation. According to the New York Times, while the New York Stock Exchange and the NASDAQ can delist a company for breaking the rules, the OTC Markets Group can only flag a stock as suspect and report it to the Securities and Exchange Commission. So what exactly was Hometown International trying to achieve by taking a new Jersey Deli and listing it on the OTC markets? Well, what they were trying to do was to create an illegal security in an attempt to work through a reverse merger. A reverse merger is often the most expedient and cost-efficient way for a private company that holds shares that are not available to the public to begin trading on a public stock exchange. In a reverse merger, an active private company takes control and merges with a dormant public company. These dormant companies are called shell corporations because they rarely have assets or net worth aside from the fact that they previously had gone through an IPO or an alternative filing process. Reverse mergers are a completely legitimate and legal way for businesses to go public without doing an IPO. In fact, you may have heard of a very similar type of process called a SPAC, a special purpose acquisition company, which is actually basically the same as a reverse merger, except in the SPAC's case, it's a brand new shell company, a corporation that has been created for that specific purpose, hence special purpose, whereas in a reverse merger, it's a merger between a private company and a public company that has a history of operating. So essentially, this deli, which operated as Hometown International, listed publicly on the OTC markets, was trying to turn itself into a shell company that could then be merged with a private company which wanted to go public without going through the IPO regulatory process. Unfortunately, some of the owners of Hometown International were doing this in a completely illegal way. According to Bloomberg, shortly after being founded in 2015, the owner of Hometown International, James Patton, allegedly conspired with Peter Coker and his son to artificially inflate the price of the company with manipulated trading. Manipulated trading is actually something that is really easy to do on the over-the-counter markets, and the reason for that is for a couple of things. One is because there is extremely thin trading volume for a lot of these companies. So if nobody is trading the shares, it makes the next step very easy, which is the value of a business, the market capitalization for a business on the over-the-counter markets is simply set by taking the last price that shares were traded at and multiplying it by the number of shares that exist for that company. And the only condition is that the trade needs to be of over 100 shares. So as long as your trade of a particular business is over 100 shares, whatever price you transact at, if that's the last transaction for that stock on the over-the-counter markets, that share price will be taken, multiplied by the number of shares, and that will be the value of the business as it's listed on the markets. A similar process is used in the New York Stock Exchange and the NASDAQ. However, it actually makes sense for those businesses, and the main reason for that is trading volume. If you're talking about a business like Apple, for example, the last trade of Apple only lasts for less than a few seconds before there is another trade. And there are billions of shares or millions of shares and billions of dollars worth of shares being traded every single day. So the last price method actually makes a lot of sense. But when you're talking about a company that doesn't have any trades for weeks at a time sometimes, you can use this process to manipulate the stock price. And that's exactly what the case was with Hometown International. The stock would often go weeks without anybody trading shares. There was only about 60 shareholders, so basically nobody was trading this stock. And Patton, along with a couple of the other people he was working with, set up a bunch of accounts that they controlled, and they just made a bunch of fake transactions that essentially allowed them to inflate the value of the stock. And this essentially meant they increased the perceived value of the company, making it more attractive for a private company to be interested in a reverse merger. And that's exactly what they did. In April of this year, Hometown International announced a merger with bioplastics firm Makama. The CEO said Los Angeles-based Makama considered Hometown an attractive merger candidate after the headlines about the deli owner because of its status as a publicly traded company. "We have investors who pushed us to go public," he said. The CEO went on to say that as soon as the merger closes, they'll be looking to transfer the shares from the over-the-counter markets to the NASDAQ, and voila. You have a private company that was able to get onto the NASDAQ without having to go through the regulatory process of an initial public offering. Unfortunately for Hometown and its owners, the party didn't last very long. This week, federal prosecutor accused Peter Coker Jr., and James Patton of artificially inflating the price of two companies through manipulative trading, one of those companies being Hometown International. Coker Sr. and Patton have both been arrested and face federal court, while Coker Jr. is believed to have fled to Hong Kong. And if that isn't stupid enough, it actually wasn't the first time that they did this. They tried to do this with another company called eWaste, where they essentially were able to manipulate the stock price from 10 cents to $10 per share, eventually giving it a value of over $100 million. Now, all three men face up to 20 years in prison on a number of different wire fraud and stock manipulation and other types of security violations. And that's where the story ends. It's not the first, and it won't be the last time that people are trying to mess around with the financial markets for their own gain. But it's certainly one of the most ridiculous examples that I've seen in a very, very long time. On a slightly different note, if you're an investor in the markets, you should be tracking your portfolio. And if you're not, you should be using something called SHARESIGHT. This video is sponsored by SHARESIGHT, a comprehensive portfolio tracking tool that automatically tracks the performance of your investments so you can say goodbye to Excel spreadsheets forever. Unlike data provided by most brokers, SHARESIGHT considers the impact of capital gains, dividends, brokerage fees, and currency fluctuations when calculating returns, which gives you a complete picture of your portfolio's performance. SHARESIGHT tracks shares and ETFs across 40 different stock exchanges, 100 currencies, commodities, and even cryptocurrencies and unlisted investments such as private equity. Plus, SHARESIGHT makes tax time a breeze by giving you a simple but comprehensive view of your capital gains and dividend income impact. Use my referral link in the description below or head directly to sharesight.com/Hamish Hodder to try SHARESIGHT for free or receive 4 months of a yearly subscription.